Yeah, guten Morgen. Welcome to QuantBox Live. It's about 7:05 on Wall Street. 2.5 hours before the open of trading. It is time to get your global macro on. Also time to drink your vegetable juice. Let's uncover the best fundamentally driven trade plans. Yeah. All right, let's go through it. We're going to look at trends. We're going to look at the fundamentals. Today, we're definitely going to go through the smart money tracker. We're going to look at the real-time sentiment. And remember, we've updated this. It's even better than the real thing. Cool, but the price is the same. So many upgrades have been done in the last couple of weeks, and a couple more upgrades are on the way. And the price is still $79 a month. Very, very cool. But if you're a YouTuber, why don't you try it? See if $8 is worth trading with confidence. See if $8 is worth trading with logic. See if $8 can organize your thought process into strong buy, neutral, sell, strong sell, etc. But maybe you just like your randomness in the market. Maybe you prefer random. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. In fact, I don't even remember the last time I uploaded the video to YouTube at all. So maybe this one will make it. I'll try to remember. At my age, you forget these things. All right, let's check our AI alert. This is an upgrade you can add to your QuantBox account, and it is pretty cool. I'm just seeing if it's easy to find it on my phone. Then log in. Probably not. I haven't even looked at my email. Can you imagine that? I haven't even looked at my email this morning. Oh yeah, here it is. So QuantBox Market Open Report is an email that I've received. Here it is. Here it is. Yeah. And I got one last night before the open of trading in London. And then I got one this morning at 5:58 a.m., which is about an hour ago. And it told me, changes in gold, changes in the German stock market, changes in the South African rand. Wow, very cool. Pre-London, there was a change in the S&P 500. And it just it was all the other stuff it repeated in New York. So cool. That's something like 80 cents a day, that email. Very, very cool. It also summarized the commitment of traders report that was updated on Friday. So you got an email about that review. So consider adding that. And we will go through everything today. Last night, there were some glitches because of all the development work being done. And I'm just hoping they had an opportunity, probably not, Sunday night, to update the glitches. And, oh, yeah, good. So, no. So, okay, so we got prices. Yield here and Bitcoin were offline. And it looks like a lot of this stuff is offline. That's interesting. Anyway, so taking a look at the world today, Bitcoin did rally up a little bit. Okay, up a couple of percent. That's cool. Yields are up quite a bit based on Friday's moves, and that's not good. So that's a disappointment here. Oil, I'm out. I'm out of oil. I got knocked out on Friday. I think it was Thursday night or Friday morning or something. I moved my stop to protect 555 pips, I think. and I got knocked out, which is good. So that's fine. Gold hasn't done much of anything lately. In fact, if I'm correct, month over month, gold is at like approximately 0 MOM. Oh yeah, and we'll see that in the risk gauge. Good. I was trying to think, where did I get that stat? Because our heat map only goes week over week. Yeah, I got it on the risk gauge. That's right. And S&P 500, whatever. We got to move today on euro. The theory is it has to do with the elections going on in France. And the logic here, I don't know if I buy it, but the logic here is Le Pen didn't do as well as people thought. So what does that mean? Well, if you have a radical left agenda and then suddenly you're going to bring in a radical right agenda, then everything has got to change, from taxation to transfer payments to trade to everything, right? And like, well, the markets have to figure out how to make money, like what's going to change and by how much. And it's hard to figure that out before it's even happened, right? But if they stalemate, then okay, then there's less change. Okay. And you're like, okay, well, it's not good for business, but it could have been a lot worse. So, there's somehow a relief rally around that. Not sure. Yeah. Well, that's what they're doing today, anyways. Euro up today. Um, I don't know. Smells like rabbits to me, because today is the first day of the second half. Today is the first day of the third quarter. And today is the first day of rabbit season. Is there anything else that is important about today? You better get this one. Canada Day. Thank you very much. Gee whiz. So we talked about this day back in January. January. Yeah. So yeah. Yeah. So anyways, today's an important day. All right. So just in case you have been around, check this out. We improved this. This is an upgrade that we have done. We've added 2 more constituencies of trading. We added the put call ratio, which represents all options trading. Okay. A put down. Okay. Put down. Okay. That's bad, right? A put down. Yeah. That's risk off. Call upstairs. That's good. It's upstairs. Market's up. Put down. Call up. Okay. So you're looking at the ratio. In days when there's more puts, the market is assuming down. When there are more calls, the market is assuming up. So, anyways, we added this put call ratio. It's okay, and it's up, which is bad. It's week over week up, which is bad, but month over month down, which is good. So there's short term short versus long term long. Okay, I know it's reverse, but that's because the put and the call. Which one is the numerator? Which one is the denominator? So down is good, and month over month, it scores a 1. The other thing is we have over here, we've always had treasuries, and we've used the 10-year T-note because it's a benchmark. Okay, thank you, Emil. In fact, if you can email me, wayne@fxbootcamp.com, I'll send that to the team. Okay. So we've always used the 10-year T-note because it's the benchmark for so many other things, but we added hot money here. which are short term. So we have long term and short term treasury yields. And we have daily, weekly, and monthly. Cool, right? So now we have one, two, three, four, five, six, seven, 8 different markets. Okay, 8 different markets. And these are traders, professional traders, and they don't really talk to each other. They don't really know each other. They're trading for completely independent reasons with completely different independent analysis. And these decisions are reflected on the direction that they're trading. So again, they're like blind tests, if you will. They're independent pieces of data. But with correlation, understanding the correlation, we can say, well, the way they're behaving is risk off. The way they're behaving is risk on. The way they're behaving is risk neutral. Okay. And then when you add them all up, you see now this broad market view of what all constituencies are generally doing. Oh my God. I hope you appreciate like the game changer, the how important this is. It's truly revolutionary to your trading. Okay. I think it's that important, this one page. Okay. And right now, what it's showing us is, well, we're on the first day of the second half of the year, and the long term and short term don't agree. Do you think we're maybe in a turning point? Very possibly. Yeah. And everybody else is just either, well, they're just going to do what they have been doing or what they think should happen. Okay. Thinking's dangerous, right? Especially when you're a former supermodel like me. Yeah, dangerous. Dangerous. So this is just informative quantitative analysis of 8 different markets and then correlating them over 3 different time frames. Holy smokes. So right now it's like be careful. You today you could be scalping risk off, but don't be shocked if suddenly risk off turns to risk on. Okay. Or 3 is going to turn into a -2 over the next couple of days. And if I remember correctly, last night this was a 4, not a 3. So something's already moving. Good to know, right? Here's that hot money I was showing you, and that is turning. Like the direction right now has been risk on, but since the 14th, so over the last couple of weeks, it's been bullish, but the trend is cooling off. So be careful. Right now, the market is cold potatoes. Okay. Once again, when we look at this is the put call ratio, bullish, but we're losing the relative direction. Okay. Okay. We are bullish, but we used to be more bullish. Hmm. Right? This is where you play with the hair on your chin. You're like, really? Right? And you twist your little chin hair, right? Really? Yeah, good to know. Okay, Bitcoin up, yields up. Okay. All right. Well, let's get rid of that. What should we look at? How about stock indices? Let's isolate that. 0.5% up for most, 0.5% down for some. Lack of direction. Yields up, that's risk off. We don't want that. Okay, that's the cost of doing business in America. You want costs down, don't you? So that's not cool. Let's look at majors. Dollar weak, dollar strong. Dollar weak, dollar strong. Dollar strong, dollar weak. Dollar strong, weak. So what's going on here? Not dollar. Good to know, right? Yeah, totally good to know. You should be cautious trading dollar today. Do you think it has anything to do with the risk gauges of some things say on the long term, sell dollar, on the short term, buy dollar? Do you think that's happening over here on the scatter plot? Uh-huh. Uh, so which one are you going to do? Well, how would you possibly know? And that's the point. So maybe you shy away from that. Maybe you should trade the yens. We could look at miners and see what's going on. Euro, 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 euro. All right, a lot of euro. Okay. Now the lowest euro is euro pound. Why? Pound, pound. Okay. Pound, pound, pound. Okay, euro strong, pound is strong. Game on. Cross pairs. You're going to trade a lot more cross pairs over the next 6 to 8 weeks. Just so you know, put it down, write this down. You're going to trade a lot more, okay, cross pairs. Why? Because there's no clear underlying intrinsic trend. So now you're going to trade relative strength. And that's where the scatter plot comes in. You're going to just simply compare what happens to be hot today with something that's not today. How long is that going to last? Nobody knows. And we call that shooting at rabbits. This is not big game. These are not trades that are going to last a month. These are market open trades. These are day trades. If you're lucky, you'll get a swing trade. But now we define swing trade as maybe 3 days, not 3 weeks. Okay. How funny they put Rand on this one. Huh. Interesting. But anyways, there you go. Cool, right? Yeah, totally cool. Now you know. Have you adjusted your trading behavior for changing market conditions? Or are you going to trade the next 2 or 3 weeks like you did, I don't know, 3 weeks ago? Are you just going to do the same over and over and over? No, you need to adjust. I need to be clear. Everything is different today. Moving forward, you have about 6 to 8, maybe even 12 weeks of not like it has been. And on this day, which I, by the way, quote unquote, predicted 6 months ago, it's not hard to have this every year. I predict there's going to be tornadoes in Tornado Alley. I predict there's going to be hurricanes in the Caribbean. Woo! Right? No, like, yeah, I don't know when they're going to happen. You know, there's one out there, St. Lucia, Nevis, right now. So, my thoughts and prayers out to the good people of the Caribbean. Did you see that hurricane that's out there? It's doing like 130 miles an hour, but it's only 35 miles wide. It's like, for a hurricane, that's like a tornado. That is tiny, but like, oh, if you get hit by that, it's, to me, I'm guessing it's going to be nastier than your regular old one that's hundreds and hundreds of miles wide. Holy smokes. Holy smokes. Okay. So, anyways, change your behavior because everything is different starting today. Okay. Trading habitually will not lead you to success. What are you trading today? I like euro dollar. No, stop it. You have to do analysis and find out that dollar doesn't show clarity on direction. So now you got to do relative strength the other way. And you're better off euro, I don't know, euro Aussie, euro yen, euro, I don't know, but not euro dollar. Mm-mm-mm. All right. So manufacturing PMI. Okay, great. Not a market mover, but we'll cover that tomorrow. Okay, that's fine. We begin the process here of CPI. We get our inflation data in the United States the middle of the month and the end of the month, so we're a long ways away from that. So we're getting some early data, inflation data out of Europe, and it's highly susceptible to revisions and stuff. So I don't know the level of importance here. Jolts, okay, expected to drop below 8. Now, QuantBox has jolt data, by the way. Why don't we look at that now? So, okay, was 8 expected to be below 8? And you're like, oh, let me go to labor market data, look at jolts. Okay. And that's where we were before. There's your 8.1. Okay. I have this going back a year, and the average is 8.84. So if we drop below 8.0 to 7 something, you could see that is a very significant drop. Okay, very significant drop. Okay, and our peak was up here at 11. Okay, so what does this show? Labor market tightening. Isn't that something the Fed has mentioned that they're looking for? So this is part of it. Isn't this beautiful, by the way? Do you like this upgrade? You're like, now I'm like, oh my God, that actually looks intelligent, right? Now you have Jolts data. When Jolts comes out, you're like, oh, now I can see it. And this is something the Fed is watching, but now you're watching it too. How pretty is that for me to just add time and stuff like that? Yeah. Okay. Notice if you go back 3 years, the average was 10. It shows you just how, oops, shows you how nutso the job opening was during the COVID, right? And then now you can go back since 2016 to now, the average is 7. So we really, for the Fed to look at this and go, okay, the labor market is loose, right? That you can uh, below 7, you could cut interest rates, something like that. Okay, tightening, loosening. Well, no, wait, brain farting, aren't I? Okay, this is the amount of jobs that are open, and so what you see here in the decline is companies advertising for less workers, or advertising less for workers. They're not advertising for less workers. Dear workers, please do not apply here. Yeah, no, 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 no. They're advertising less for workers. Now, why? They don't want to hire. So maybe when companies let people go, right? There's less. So this tells you a couple of things. Unemployment could go up. This just shows there's less work. That's all. Okay. So unemployment could go up, but also wages could come down because imagine there's 11 million jobs and 5 million workers. So now you got 3 or 4 job offers, right? When you decide to quit your work. By the way, you decide to quit versus get laid off, right? You decide to quit. Why would you quit? Because I got like 5 job offers. And which one do you pick? Well, the one with the best compensation, right? Yeah. So when you have no job offers waiting for you, you don't quit. Okay. And wages don't go up so much. So this is sort of I suppose you could say a leading indicator. Okay. And I don't know if you follow this that much, but I can tell you my my professor, what was his name? Green. Professor Green, who was a senior economist at the Boston Fed, this was one of his favorite things. This was like his baby. Okay. We spent a whole lecture just on jolts, and it was on the exams. Okay. So for a professor to spend, this amount of time, it's important. And I can say, and that's luckily I went to Harvard, right? Because now I can say, in my opinion, the Fed does watch jolts. Okay. Cool. So, anyways, now you can look at that and play with that. How cool is that? It's so cool. Let's go back to the econ calendar. So there's your jolts. ADP, another dumb prediction. That's on Wednesday. What's this doing here? Is that really that's a that's a that's wrong, isn't it? Oh, because of the holiday. That's interesting. That could be a horrible mistake. They're doing it a day early. Wait, early work by the government? Oy vey, you know? Yeah, because 4th of July. Okay, we'll get that to a second. So, services, we care about this. I forgot about that meeting minutes. All right. ADP. We can look at claims 233. So there's the 233. And it was 238 with revised down to 235. Mm, come on, Bubba. Mhm. How could that be exactly 200K still? That's probably not working. All right. But pretty steady, huh? Going back 222 weeks. That the thing is it's only going back to here. That's what it is. That's not 222 weeks. All right. So we don't have that much data. All right. Oh, maybe it's days. 222 weeks. Let's see if I have that kind of data. Oh, I do. All right. Holy smokes. Yeah. look look at the data then, huh? Yeah, let's see if I can get rid of some of that. Wowzer, huh? Do you think that's COVID? Whew. Even then, wow, look at that. It's cool to have that data, huh? Look at that. We were pulling eights. Wow. All right, let's go back 150 weeks. Oh, come on. Whew. Even then, 364,000 back in 21. Interesting. Look at the ebb and flow, ebb and flow, ebb and flow. That's neat. Okay, let's take this down a lot. All right. Yeah, that's interesting. Interesting, the ebb and flow. I wonder if that's seasonal. Excuse me. Wonder if there's some seasonality to that too. That'd be interesting to study that. So looking at that, mm, okay, that would this move here would allow the Fed to cut interest rates. It's harder to see when you're just a little bit zoomed in versus anything. So we can go 1 year now. Oh, come on. It's 52. See, I look down, and then when I look down, it changes. 52. There we go. 52 weeks. Yeah, there's a bit of an upward trend here. This is nice. This is why we have this tool to be able to play with it. We can see zoomed in. I mean, I can see it a little bit better zoomed out. So I'm glad we took the time to do that. But for 6, 7, 8, 9, right? Doesn't it seem like there's a bit of a trend to the upside over the last, we'll call that a quarter? Would you see it that way? Well, that is what the Fed is looking for, and that would allow the Fed to cut interest rates. If, in particular, if that continues. So what we want to see is, you know, higher unemployment claims, assuming you want the Fed to cut interest rates. The Fed would look for higher unemployment claims, and they probably look at a 3-month average. Okay. Um, and then the second thing is they want to see a lower non-farm payrolls. So that comes out first. Okay. Interesting, huh? See, I'm working on my American accent. Yep. Mhm. So yeah, we got those claims, ADP. Okay, FOMC meetings. This will be good. Services. So Wednesday is a massive day. This is usually a good scalp, ADP. And then a little bit after that, the claims, which could be, again, a bigger claim could be good. Then services at 10, and then this at 2. Like, this is a monster day. Then you have Thursday off. What's going to happen on Thursday that's not on this calendar? The Bank of Japan is going to intervene in the market and push all your yen pairs down. And then you're going to owe me a cocktail for predicting it a week in advance. Literally a week in advance. Yeah, on Thursday at the swing trading meeting, that was one of my predictions. Yeah. Which is you're like, Wayne, why do I have to buy you a drink if I already subscribe? Isn't that your job? Yeah, it is my job. But if it gets us together, then it's worthy. I just want to hang out with you. That's all. So that's probably going to happen Thursday, and then you're going to take the rest of the week off, right? No, no, no. Because we got non-farm payrolls on Friday. Not a bad week. So jolts a little bit. Wednesday, oh, for show. Thursday is the blind side by the Bank of Japan. And Friday, NFP. Complicated, messy week, but it's going to be important. Now, does anyone want to know why I say Bank of Japan will intervene on Thursday? Should I just skip it? Everybody knows because we got to do our COT. Here's the thing. When you're a central bank and you're trying to spook the market and get people out of their trades, it costs you money. You have to buy your own currency. And if you're going to move the market 500 pips, bro, you got to buy a lot of currency, especially if people are pushing back. They're long all the yen pairs, and then suddenly the Bank of Japan has to short all the yen pairs. They're going to need a lot of moolah. Well, what if nobody's trading that day? What if everyone just jams their stop because they're worried about intervention and they go away on holiday? And they're drinking the brewskis and playing with fireworks because that's the American way. Yeah. All right. Well, then you need a lot less money if you're the central bank because you're going to buy all the yen, buy the yen by selling the yen pairs. Then you're going to hit those stops, and no one's going to buy it back. So it'll just cascade where the stops make the yen stronger, which drop the yen pairs a little further, which hit more stops, which hits more stops, which hits more stops. And they're able to wipe out a significant amount of the market with the least amount of money. And if that was your intention as a central bank, if I was running the bank, that's what I would do. Okay. Yeah. Okay. Remember, the UK is distracted by elections as well on that day. So when nobody's looking, boom, they blindside you. Yeah. So, anyways, get ready for that. Okay. Gold and oil and silver, platinum, copper. Fine, fine, fine. CAD still being punished. Yen. Look at Swiss franc finally, huh? Yeah. Remember, that was strong for a while. And we're like, it's not supposed to be. The central bank is cutting interest rates. They want a weak Swiss franc. And now you got it. So let's take a look at the net change. Aussie Kiwi Platinum. Nazi. Still a move to Nazi, but notice it's 50-50. Okay. Kiwi really has moved, huh? Remember how bad Kiwi was 6 months ago? Now it's 72% long with a 4.5 increase in flows, mostly buyers and a loss of sellers. That's a very, very emboldened move. Oh, 1 second. Yeah, that's a big move. Same thing with Aussie. If you think about it, look at 9,000 less bears and they all became bulls. That's real, huh? That is something. Wowzer. NASDAQ, less bears. But where did they go? What did they buy? They just went to cash? They didn't buy yield or the treasuries. Look how bigger these treasury market is, huh? Just crazy how much bigger it is versus the stock market. 33,500 less bears on the treasury market and 14,000 new bulls, right? Pretty amazing. A lot of neutral here, just money coming out of the stock, out of it, S&P 500. Bulls and bears, people are just getting out. Hmm. So let's flip it. Oops, come on now. Nikkei. Okay. People are now shorting it. It's still 70-30 long, but things could be changing. This is something that you want to pay attention to. Now, when Nikkei goes up, yen is weak. If Nikkei flips and becomes bearish, yen is probably strong based on normal correlations. We got a lot more bears week over week. Wait, 186%? No, 187%. That's a big change. I don't know about you, but I consider that a big change. And on the week before Canada Day, Dow turning more bearish than bullish the week before Canada Day. See, if you missed it back in January, I said Canada Day today would be a time period in which the stock markets could top out for the entire year. Now, I said it in January. I did it was a 2 or 3 hour presentation. Like, it's not like I just blurted it out once and now it looks good. No, it was a 3 with what did I have? Like 15 charts that we went through. I mean, like a serious presentation. I charged over $4 for it. I think it was 444, wasn't it? I can't remember. Yeah. Um, and here we are, like, wait, what? On the week before Canada Day, Dow actually turns bearish. That's an amazing coincidence. And the week before, there was 187% change to the amount of bears in the Nikkei, even though it's been incredibly bullish. Wait, the week before Canada Day. Uh-huh. In fact, Tuesday before Canada Day, right? So, anyways, you're like, oh my God, that's a 17% net change to the downside. Uh-huh. It's amazing coincidence, some of these things. Now, if you go to your charts as well, I guess, why don't we do that? If we go to the charts, um, again, today being Canada Day, I guess I'll just draw on this. I'll just, okay. You have, right? What do we see here? Oops. Potentially a double top. Now, it's still bullish. Look how bullish all of this is, right? Oops. Okay. Like, it's still bullish. But it's kind of interesting in January to say, well, the window for opportunity for a reversal begins Canada Day. and we have a double top on Canada Day. So if it now makes a lower low, lower high, so the beginning of that has formed on the day. Okay. So I don't know if that's going to happen, but boy, if it happens, you better take it seriously. That's the whole issue. It's not a prediction, it's a hypothesis. There's a difference. Prediction is guessing, hypotheses is analytical probabilities, right? It's a hypothesis. So if you see it come to fruition, then you should act. Okay. So I'd be eyeballing this if I were me. Okay. And what about, here's another one. What about NASDAQ? I got to go over here. Okay. We're talking about the early January prediction of Canada Day being the top of the stock market for the year. Okay. Well, let's take a look. About a week ago, we hit the, okay, the annual, or I guess yearly, let's do it that way. Yearly M4, which is the conservative predicted top. Think of that. In January, we would say, well, I think the NASDAQ, where'd my mouse go? Hello, mouse. Really struggling with my mouse today. I'm going to have to replace the battery by the time I get to the next webinar. It's that dead. Where did it go? Mousy. It's not moving. It's not moving at all? How could it be that dead? All right. Well, I guess we're going to have a webinar into perpetuity. No, I see it. It's just not moving. Yeah. Anyways, okay. So back in January, oh yeah, with the use of pivot points. Oh man. I'll leave it there because I'm going to need the rest of the battery just to end the webinar. So I feel like we're really close. Anyways, oh yeah, the summer school's going, isn't it? Oh, no, that's noon today. All right. So back in January, with the use of pivot points, we would have said 20,082 is a very logical and intelligent predicted high for the year. It's not me coming up with some number, and it's not just random like 20,000. We have a very specific number. All right. And it's one probable price in which the market could top out and then fade down. We don't know in January. It's just the logical price. Now, the second thing is I use my experience and I use seasonality on QuantBox. And I say, well, irregardless of what the price is, what seasonality tells us is the time. I don't know what the price will be, but Canada Day, July 1st, today, is another important part of the equation. That is the probable timing of a top for the US stock market. Put them together. Canada Day, there's only really two prices. There's the R2 above us, but the conservative target, based on logic, what I teach in all the training courses and everything, is that on Canada Day, the NASDAQ will be at 20,082. And the day before, we essentially, like, almost precisely, s- like within like an hour of accuracy. And I find that, even though it was something I said, I find it extraordinary. When it tells me is I teach you the right things and I teach you to use the right tools, and look at the accuracy we got within like just hours of trading accuracy, just a handful of points of accuracy 6 months in advance, not just the price, but within 4 hours of Canada Day. Like, so, could this be the peak for NASDAQ? Maybe. I don't know. But what I share with you is the logic and the modeling and the quantitative analysis and the use of history, right? Seasonality, the shape, the shape of the year. And it's very important if you're going to have longevity, what I call sustainability. If you're going to be a trading business, you want to have a sustainable business, and understanding the shape of the markets is important. So, I'm emphasizing here it's not me with some sort of God given genius. No, 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 not at all. It's not me at all, because when I first started trading, I didn't know anything about anything. What this was is seasonality with pivot points, and we have that level of accuracy. It's it really is unbelievable. No one would believe it, but you were there. I'm pretty sure you were there, and we went through it over hours to explain how to get to that conclusion. And there you go. So you got it. You got the right tools. Now you have to, learn execution. Okay, and you'll be fine. So I'm going to fiddle around with my mouse and see if I can end the webinar, but I will let you go. So I'll bid you adieu. Peace on earth. May the pips be with you. May your profits be above average. Cheers.